Stop scrolling for just a second, because if you own stocks, ETFs, crypto, or anything tied to tech right now, this might be the most important video you watch all year. The market has officially flipped, and most people still don't realize what's happening. While everyone is panicking, selling at losses, and watching their portfolios bleed red, one ETF is quietly doing something shocking. And no, it's not AI, it's not tech, and it's definitely not crypto. Today, I'm going to explain why SCHD could be the best dividend ETF of 2026, why it may even outperform the entire market, and how smart investors are repositioning right now without destroying their future gains. Before we go any further, if you care about protecting your money, growing long-term wealth, and actually understanding what's going on instead of reacting emotionally, make sure you subscribe to Stockora right now. This channel is all about simplifying investing, cutting through the noise, and helping you build real wealth step by step. Subscribing literally costs nothing, but not subscribing could cost you years of mistakes. Also, like this video early because it helps more investors see this message. Now let's talk about what's really happening. Year to date, the S&P 500 is barely positive. QQQ is down. The technology ETF VGT is down over 5%. Bitcoin is getting crushed, down more than 16%. AI stocks that everyone loved just months ago are suddenly the biggest pain points in portfolios. People are finally waking up to a harsh truth. Their portfolios are way too risky. And when fear enters the market, money moves fast. But while all of this chaos is happening, SCHD is up over 11%. Let that sink in. While tech is falling, while crypto is collapsing, while speculative assets are getting wiped out, SCHD is quietly climbing. And this is not luck. This is positioning. This is exactly what happens when the market transitions from greed to caution. I've been saying for a long time that this shift was coming. Not because I can predict the future, but because markets always move in cycles. When risk appetite is high, growth dominates. When fear creeps in, value takes over. And right now, value is back in control. A lot of people wrote off SCHD over the last few years. They called it boring. They called it slow. They said it couldn't keep up. But here's the thing most people miss. SCHD was never designed to win during tech bubbles. It was designed to survive when bubbles burst. And that's exactly what it's doing now. Since 2011, SCHD has averaged over 12% annual appreciation, even including years where people complained about its performance. On top of that, it pays a dividend around 3.8%, and that dividend has grown every single year, often by double digits. That combination is incredibly rare. Stability, income, and long-term growth all in one place. Let me make this real for you. Imagine you put $100,000 into SCHD. You don't add anything else. You reinvest the dividends. You're in a tax-advantaged account like a Roth IRA. If the dividend grows conservatively at 7% and the price appreciation averages just 10%, in 20 years, that $100,000 turns into over $1.1 million. And at that point, it's paying you more than $25,000 per year in dividends. Now imagine you add just $1,000 per month. Same assumptions, same conservative numbers. In 20 years, you're sitting on over $2 million and earning nearly $4,000 per month in passive income. That's not a fantasy. That's math. That's patience. That's discipline. And this is why SCHD is becoming a cornerstone again in 2026. People are realizing that chasing the hottest asset every year is how you lose money, not how you build it. Right now, investors are fleeing high-risk assets, not because they hate tech, but because fear changes behavior. When portfolios start dropping fast, people don't want excitement. They want safety. They want predictability. They want income. And that money has to go somewhere. Cash accounts and high-yield savings might feel safe, but there's a problem. Rates are coming down. A new Fed chair is stepping in, and lower rates are almost inevitable. When rates drop, The return on cash drops, but inflation doesn't disappear. That means your money slowly loses purchasing power. So investors look for the next best thing, something safer than tech, something that pays more than cash, something that can survive downturns. That's where SCHD comes in. SCHD's portfolio is built for moments like this: heavy exposure to energy, consumer staples, healthcare, industrials, and financials. Almost no tech, no single stock dominating the fund. Strong companies that generate real cash flow and return it to shareholders. And here's something most people don't talk about. The worst year SCHD has ever had was around -5%. That's it. Many ETFs drop 30 or 40% in bad years. SCHD barely dips. That's a massive safety net when the rest of your portfolio is under pressure. This is why I always talk about balance, not abandoning tech, not going all in on value, but building a portfolio that works in all environments. When tech is flying, growth carries the load. When tech crashes, SCHD holds the line, and through it all, dividends keep flowing. If you're still with me, comment SCHD below. I want to know who's actually paying attention, and share this video with someone who's stressed about their portfolio right now. You might save them from making an emotional mistake. Now, let's talk about the mistake most people are about to make and how you can avoid it. When markets drop, emotions take over. People either panic sell everything or double down on risk because they're desperate to recover losses. Both moves can be dangerous. If your portfolio is overloaded with tech and speculative assets, selling everything right now usually means locking in losses. That's not strategy, that's emotion. At the same time, blindly buying more tech just because prices are lower can make your risk problem even worse. The smarter move is reassessment. Ask yourself honestly, can you sleep at night with your current portfolio? If the answer is no, that's a signal, and signals should be respected, not ignored. This is where SCHD plays a critical role, not as a replacement for growth, but as a stabilizer. Think of your portfolio in three parts. One part tracks the overall market. One part focuses on lower volatility and income. And one part takes calculated risk for higher growth. SCHD sits firmly in that second category. When markets are good, SCHD doesn't need to be exciting. It just needs to be reliable. When markets are bad, it becomes the anchor that keeps everything from falling apart. That's how real portfolios are built. What I'm seeing right now is a rotation. Money moving out of hype and into fundamentals. Out of stories and into cash flow. Out of promises and into proven systems. This doesn't mean tech is dead. It means tech is no longer the only game in town. If markets bounce back, that's your opportunity to rebalance intelligently. Trim some risk, strengthen your foundation. If markets keep sliding, dollar cost averaging into value becomes even more powerful. And this is where long-term investors win. Not by predicting every move, but by preparing for every outcome. Remember, past performance doesn't guarantee future returns, but ignoring history is how people repeat mistakes. SCHD has survived recessions, crashes, and bear markets with minimal damage. That doesn't make it perfect, but it makes it dependable. If your goal is long-term wealth, financial freedom, and eventually living off your investments, ignoring dividends is a mistake. Dividends give you control. They give you income without selling assets. They give you flexibility when markets are ugly. That's why SCHD is not just relevant in 2026, it's essential. If you've learned something from this video, do 3 things for me right now. First, like the video so the algorithm pushes this message to more investors. Second, comment your thoughts or questions below because I read every single one. And third, share this with someone who's stressed about their portfolio or confused about what to do next. This is Stockora, where we don't chase hype, we build systems. Stay patient, stay disciplined, and I'll see you in the next video. And here's something most people don't talk about. The worst year SCHD has ever had was around -5%. That's it. Many ETFs drop 30 or 40% in bad years. SCHD barely dips. That's a massive safety net when the rest of your portfolio is under pressure. This is why I always talk about balance, not abandoning tech, not going all in on value, but building a portfolio that works in all environments. When tech is flying, growth carries the load. When tech crashes, SCHD holds the line, and through it all, dividends keep flowing. If you're still with me, comment SCHD below. I want to know who's actually paying attention, and share this video with someone who's stressed about their portfolio right now. You might save them from making an emotional mistake.